Hi, I'm Sam Sells, and welcome to my podcast, Clean Money. I'm a serial entrepreneur that has led over 2 billion development projects around the world. But the work I am most proud of is the work we do here at Wild Mountain Capital. We not only create great returns for our socially conscious investors, but we make an impact in the many communities we work in and we change lives. I like to say investing matters, and my show is to talk with everyday folks that are not only creating great success, but making an impact in society and improving the lives of others. That is my mission, and I want to share my stories and others with you. Welcome to Clean Money. Hey everyone, thank you for joining with us today for another great episode of Clean Money, where we talk about making a difference in the world through our investments of time and resources. Our guest today is Jacob Vanderslice, who is a co-founder and principal at Van West Partners, a Denver-based real estate investment company specializing in the acquisition, development, and management of self-storage facilities. Under his fundraising leadership, Van West has strategically deployed over $375 million in capital into value-add self-storage facilities across the United States. Welcome to the show, Jacob.
Great to be on, Sam. Thanks for having us.
Yeah, thank you for joining us. Now, we share a similar history, and I just want to dig into that just for a second, if that's okay. You were a firefighter.
I was. I
Yeah,
was.
tell us about that just briefly.
Yeah. I volunteered in college, and my now wife at the time, she was not my wife, but she broke up with me, and I was like, oh, I'll go do this for a career. So I took a test and got a job offer,
Yeah.
and went through fire academy, and I put on my bunker gear every night and drive the medic unit to calls. I don't know why I took this on, but they needed a C-shift arson investigator. So I was the arson investigator for a while. And it was a fun ride. I had a blast, but I'd always wanted to be self-employed and be an
Yeah.
entrepreneur. I was fascinated in real estate. And most guys and pretty much anybody who joins the fire service stays in the fire service for their entire career. It's pretty rare that somebody leaves.
Yeah.
And I just wanted to free up time and kind of go do my own thing in real estate. So I left in about '06, and I've been gainfully unemployed ever since then. But it was a lot of fun.
Yeah, that's fantastic. Yeah, I joined the fire service in 2003 and did that through 2009. So my early 20s when I joined, 22 years old, and did that for about 6 years.
Yeah, that was about the same age as me. I was the youngest person in our academy, by quite a bit, I think. I was definitely the young buck there. It was a
Yeah.
blast, though. One thing I thought about when I went into it, not knowing much about it, I thought that I was going to be, the American hero pulling a hose line into a burning building like once a week, and
Yeah,
carrying
Backdraft,
carrying
right?
out
I think that was the movie.
I know, and common misconception that could not be further from the truth. You're more of a social worker than you
Yep.
are a firefighter. You get a call and I'm digressing for another moment here, but you get a call at 2 a.m.
Uh-huh.
and the lady says, you get there like, what's going on? Oh, my leg hurts. Okay, your leg hurts. How long has that been going on for? Oh, it's been hurting for about a month and a half. And then you think in the back of your head, so you call us at 2 in the morning,
Uh-huh.
after 6 weeks of this happening, you call us at 2 a.m. So your next question is, well, what made you call us tonight? Oh, I couldn't sleep. Well, do you want to go to the hospital? Yeah, I probably should. Okay. Do you want us to put you in the pram, or do you want to walk to the I'll walk to the ambulance. Grabs her bag, walks out, lays down, put the seatbelts on, O2 vitals, transport, and that was a lot of our calls.
Yeah.
So yeah,
Yeah.
that probably rings a bell for you there too.
Yeah. Same
But,
thing.
yeah,
It's yeah, I don't want to walk down the stairs. Okay. You're 350 pounds, Sam. You're 5'7", 160 pounds. Do you mind, being, let's get the stair chair out and let's put you in there and we'll carry you down the stairs and see how much of a man you are, Sam.
yeah. Stair chairs, the old whale tarp. Yeah,
Oh
we
yeah.
did it all. Those were fun days for
Yeah.
sure.
Fun
Yeah.
days. Yeah. And so right too. It's just um I learned a lot about the human condition and how a lot of people live and
Yeah, I was raised pretty sheltered, and it was very eye-opening for me. Absolutely.
Yeah.
Yeah, and it prepared me for real estate. It prepared me for being a real estate hack. I see the same stuff now that I did, almost 20 years ago, I guess.
Yeah, I got into real estate with a couple of fire buddies of mine, and on our off days, we were working the 24-hour shifts, and so the off days is when we dug into residential real estate back in 2006. For me, I think is when we started flipping properties, is 2006. But
Yeah, I got in at the same time, and I got beat up pretty badly, and eventually came out the other side. But
yeah,
it's
so
been a
let's
ride.
let's talk about that. You've been doing this now for a long time, and I've heard people who've been long time investors, like I never invest with an operator or with somebody who hasn't been through at least two cycles. And I thought that was pretty savvy thing to say. Of course, he's a very, very savvy investor who first time I'd heard that. So what does it mean to have been through a couple of cycles, and let's just talk about some of your lessons learned over the years.
Yeah, I remember the failures like they were yesterday, and the home runs that we've hit. We when we bought the deal, whatever deal it might have been, you never dreamt it would go as well as it did. And often those home runs are, frankly, you got to have execution and operational excellence and conservatism, but so much of it comes down to luck and timing, right? Who knew what was going to happen with this rising rate environment, which I'm sure we'll talk about in a moment.
Yeah.
But I remember the failures, and I've learned the most from the failures, and the successes. Frankly, I haven't learned much from those. I know more of what not to do than what to do, and every year I get a little bit less stupid, along with my partners. One of my partners I go back to junior high with, and he joined me in real estate in about 2008. And our other partner used to work for us, and we partnered with him on our first deal 10 years ago. So it's not three people that just kind of got together on a whim and let's go try some real estate out, starting last year. And we learned something every year on kind of what not to do. And getting started, um, I bought a bunch of rentals. Obviously, back then you could finance anything.
Yeah.
You
Yeah.
get 10 houses on a small W-2.
Hmm.
And what I didn't think about was, gosh, the rental income is not as high as the mortgage payment. I didn't really think about that. Went to college for history. I was a pilot. I got my pilot's license. I was thinking about like going military or airlines. I didn't know anything about finance, and I just kind of went into it. And a lot of lessons learned. And as the wheels are kind of coming off the bus, we've got all these problem deals, but at the same time, we're going to the trustee sales, the auctions, and we're just robbing deals relative to where they traded previously, like 50% of what they might have sold for back in 2006. It was
Yeah.
a weird time because you're
Yeah.
balancing all this pain, but you're also seeing massive opportunities, but you don't have the foresight to know how much of a deviation from the mean you were buying into.
Hmm.
And had we had that foresight, we instead of trading, buying, fixing, and selling over and over again, we would have had the discipline to hold a lot of those in our inventory as rentals. And who knew what direction the markets would go, especially in the last couple of years.
Yeah.
Uh, so I guess a couple things that I've learned high level over the years is first of all, the model is always wrong, right? The
Yep.
deal never goes like the model says it will, no matter how conservative or aggressive or whatever your assumptions are, the deal never goes like the spreadsheet. And the second thing that I learned is transacting quickly over and over again, buying and selling quickly. It produces cash to a degree and it produces income, but it generally does not create wealth. And I think wealth creation is accumulating assets that are responsibly financed and operating those efficiently and holding them, not indefinitely, but holding them. And then eventually, when it's appropriate, monetizing that value creation. But for many, many years, I mean, we did over 1,000 fix and flips all over the country, but mainly in Denver. And had we had the discipline to hang on to a small fraction of those, we'd have quite the portfolio. But we didn't. We traded. So I think just knowing that your model's wrong and kind of giving yourself a little bit of flexibility on knowing that it's not going to go like you think it will, and just accumulating assets and holding on to them is how you do it. I'll let you know how it goes in 10 years from now. We'll see.
Yeah, I see a lot of these newer folks to the game, and on their websites, it's hey, a 37% IRR. Like that probably happened because you bought it in 2020 and you sold it in 2022.
I'm not trying to disparage other operators, and I can definitely disparage myself a lot more than anybody else. But I see the same thing. And when you see these pitch decks of round trips and track record, and you see these IRRs and multiples that were put up in 2021, early 2022, that return is not unique to that operator. Everybody was doing those returns. Maybe that's egregiously high, but everything was
Yeah.
working. And if you were terrible at execution, let's say you built an apartment building, let's say you were a fix and flip guy, you went to your first multifamily syndication, you might have been way over budget on your hard costs. It might have taken you a lot longer to build than you thought it would, but you were saved by two things. You were saved by rising rents and compressing cap rates, and you came out the other side a hero. But the market floated your boat all the way up, and those days have been over for a while now. The market's not saving deals right now. So when you talk to an operator or a sponsor and you consider investing with them, they're talking about their returns. You got to put those into context. And the big question you got to ask is when? When did you
Yeah.
buy? When did you sell?
Yeah.
It's like I got a buddy that's really good in the stock market. He made a 25% return. Well, when? When did he go in and when did he come out?
Yeah.
And that timing and the history of their track record, I think is important to understand.
Very, very important. And I wholeheartedly agree. And that's, back to you know, the saying of, invest with people who have been around for a while and have done it. And you've seen the ups and downs. I remember buying homes in downtown San Antonio for $50,000 a piece in 2006, 2007, even early 2008 before the markets just went crazy, and we were turning around and selling them for 130. When the market broke, we were still fine because our basis was so low.
Yeah.
Contrast that with, an apartment complex that it's like a 70% IRR, things that I don't ever advertise because they're so outlandish. It doesn't make sense. I don't tell people that. I don't want them to get the expectation, right?
Right.
That
Right.
was a
Yes.
one-time good deal, and, it'll skew everything. So it just stays out. But the guy who bought it and, picked it up, you know, it's about to go into foreclosure because
Mhm.
the rates and everything else. And so terrible timing for him, great timing for us. It was, you know, and I know him, we keep in touch and he keeps telling me on the property where he's at and what's going on and his struggles and, um, you know, luck.
Yep. Yep. Yeah. You mentioned basis earlier. We've never had a bad deal before. We've only had deals with a basis problem.
Yeah.
That's it. Yeah.
Yeah. Yeah. We have a basis problem deal right now with, a complex in Memphis, Tennessee, where crime has gone up by 300 and something percent.
Man.
Execution wise, we're sitting at like 33% expense ratio. We're 97% occupied. In that market, we have the highest occupancy and the lowest expense rate in that area. So we are outperforming by a long shot. But crime has gone up so much because of the political ridiculousness there in the
Yep.
city that coming up on a refinance, it's like valuations have dropped. And so our basis now is a problem because valuations have dropped so much. Execution, fantastic.
Well,
But yeah,
let's schedule another episode in the coming months, and we'll cry to each other for an hour about all our deals that went wrong.
yeah, yeah, yeah. It's just interesting, and I appreciate that. So tell me, um, you've been in this, you're talking to a lot of investors right now. What are people concerned about?
So there's a general reluctance out there, and to a degree, I would also say a general fear. And that fear is not necessarily unfounded. And a lot of the feedback that I get is kind of wait and see. I'm going to wait and see for the rate cut, which we're recording this today on the day of the 50 bip rate cut. We were in an investment committee meeting when we got the news, and we all
Yeah.
stood up, very loudly cheered, and my right hand still hurts from all the high fives we were passing around the conference room. Like it's bright red still. Um, so the high rate environment has created fear and uncertainty and kind of reluctance. But we talked to a lot of our investors who have seen major performance issues in various syndications and funds they've invested in. They've seen equity wipes. I talked to one of our investors. She told me that she had put in about 100 grand each into 5 multifamily syndications. One of them sold and she got $1,000 back. Um, 2 others have ceased distributions, and she thought the other 2 or 3 were potentially going to see complete equity wipes. So when you're seeing that kind of financial hit, and you go into these with a risk of loss, but you generally, I think a lot of people think, oh, they're targeting a 15 or 20 IRR. If it doesn't go well, maybe I get a 10. They don't
Yeah.
generally think about if it doesn't go well, my money goes away. So a lot of people are experiencing that, and not only does that chew up their cash, but it creates reluctance and putting their money into new deals. And I also hear, I mentioned this a moment ago, it's kind of a repeat of this thought, but I'll do it anyway. The wait and see attitude. I'm going to wait for a dip. I'm going to wait for a big devaluation. I'm going to wait till I see steeper discounts and more of a decline in asset values. And it's all market by market. You've certainly seen that more so in office than you have in, other asset classes. But this kind of wait for the dip attitude. And the problem with that to a degree is, first of all, you're inferring there's going to be a dip. And I would have guessed that given when COVID kicked up, which I hate even talking about COVID, but when that kicked up,
Yeah.
I would have thought there was going to be a massive decline in asset values, went the opposite direction, right? So
Yeah.
had we kind of sat around and waited to see, we would have we would have missed out on a lot of opportunities. We just kind of waited.
Yeah.
So you're assuming there's going to be a dip, and then finally, you're also assuming that you're going to know when you're in the dip. And in my experience, and they're probably the same as yours, as valuations plummeted back in 2008, we weren't like, oh yeah, let's scoop up everything and hold it. We were trying to get in and out as fast as we could, right? Ride
Yeah.
that falling knife, execute your fix and flip in San Antonio, buy it for 50, sell it for 130.
Yeah.
And we were scared. We were trying to just recycle capital as quickly as we could. So there may not be a dip. And then secondly, if there is a dip, you're probably not going to know that trough happened for 18 months or 2 years. Then you
Yeah.
look back in the rearview mirror and say, all right, that's when it bottomed out. So you can't time it, is what I'm trying to say. And in the best and the worst of times, there is always a good deal out there with risk-adjusted returns. It's never a good or a bad time to buy. There are deals that have good risk-adjusted returns and deals that lack risk-adjusted returns. So that's kind of the sentiment I'm seeing, but I'm cautiously optimistic that I'm seeing sentiment improve the last month or two. People are getting a little more engaged in our various offerings. There's still some reluctance. People are still hung up on cash flow. They want cash flow in year one. Our deals the last few years did not have that at all, just because of higher values, higher interest rates. But we are starting to see in the deals we have in our acquisitions pipeline, certainly not what it was back in 20 or 21, but we are starting to see year one positive distributable cash flow come back. So we'll see how things go going into
Yeah.
25.
Yeah. We're seeing very, very similar things. And it was kind of a long dip in investor sentiment for a while for us, and seeing that come back with a little bit of hiccups. We had a little bit of a hiccup around when the first assassination attempt happened on Trump. And this second one happened, and I was talking to an investor right, the day right after, and we just mentioned this briefly, was before the call started, that they said, oh, I'm nervous. The political landscape's very hairy. I'm going to sit for a little bit and wait. And perfectly understandable, fear. What's the quote? Be greedy when other people are fearful, and be fearful when other people are greedy. 2021 was a greed year for sure. And a lot of people at that time were saying, hey, I'm out. People were,
Yeah. Another way to say it too, not exactly, but human nature, the fear of loss is
Mhm.
more powerful than the desire for gain. People are
Yes.
much more afraid of losing than they're much less so desiring to create wealth.
Absolutely.
So
Yeah.
yeah, it's a tough dichotomy in this environment.
Yeah, yeah, interesting. I think it's gonna be really interesting to see how the world churns over this next year. But today's announcement by the Feds dropping it by 50 basis points is um, significant. What do you think that's going to have? What do you think is going to happen to the market?
Yeah, it's so we've all been talking about this debt maturity wall. And my future forward-looking assumptions are always wrong. But we thought we were going to see a debt maturity wall a year ago. All these
Mhm.
floating rate loans maturing, they can't refinance. Well, we never saw it. And now that this rate cut has happened, most of those floating rate loans are indexed against SOFR, which is basically correlated to the federal funds rate. Um, 50 bips is not going to save deals, but it's going to help for sure. I think it's gonna start to shake loose some more transaction volume. I think it's going to instill some confidence in buyers and sellers that was lacking before. Perhaps that bid-ask spread is going to start to narrow a little bit in all asset classes. I mean, that's why transaction volume is down so much, at least in self-storage. I think to a degree in multifamily, is sellers want a lot more than a buyer can pay. And why is that? Well, the buyer's looking at their model saying, dude, I got to finance this at a 6.5 or 7% interest rate, maybe lower now. And I can't pay you a four cap anymore because
Yeah,
it doesn't work. And the seller says, well, I'm not selling it to you for that low of a number. So I'm going to kind of hang out and wait for a better day. So that gap incrementally is going to maybe start closing with this rate cut. But for our portfolio, we have a lot of floating rate debt that we intentionally originated after rates are really high, because we didn't want to be saddled with prepayment penalties. It just made sense because we weren't confident that rates were going to go up. We weren't too worried about that.
yeah,
Um, so in our portfolio, this rate cut roughly today will save us about $250,000 a year in interest carry on our loans that are indexed against SOFR, and that's meaningful.
yeah,
That's real money, 20
yeah,
grand a month.
yeah.
Um,
$5 million
and
dollars in valuation. I mean,
and yeah, and hopefully more to come. I mean, that's
yeah,
net distributable cash flow dollar for dollar that we can kick out to our LPs that we couldn't kick out before. And we're refinancing a lot of these, so that'll, the order of magnitude will increase there. But yeah, it's no doubt it's a positive thing. But could it go the opposite direction and create a decline in value? Suddenly, a bunch of new inventory hits the market, maybe like in the single family space. If you would have asked me a couple of years ago where residential values would go if rates went up like they were going to, I would have said they were going to plummet, right?
yeah,
Oh, no one can afford that. And, mama's wrong again, but, borrowing from the water boy, the values went up. And the reason they went up is nobody wanted to sell. They didn't want to pay off their three
yeah,
and they make money, but then they pay the same price or more for a new house and they borrow at a 7. So I'm not going to sell. I'm going to do a HELOC. I'm going to redo the kitchen. That's why values have remained so buoyant. So could this create a spike in inventory, not just in residential, but in commercial? And obviously supply and demand, the more inventory, the values go down. Could it go the opposite direction? Time will tell.
yeah. And when you look at it, you felt that way because that was our experience in 2008, right? Home prices plummeted. For us in the quick transaction game, it just meant that we got a little bit less in proceeds. So instead of me selling them at 130, I was selling them at 110. I was still closing the deal and still making money, but I just wasn't making as much. Um, in 2008, the problem was getting access to debt. I think my
Yeah.
greatest fear is debt markets imploding like they did in 2008, where you just could not get debt, period. You couldn't get a refinance, you could not get debt.
Yeah, I say that we didn't have the discipline to kind of hang on to these back then, but I also don't know if we could have, right?
Yeah.
Or we've gotten the debt financing to do it. We have a very sharp, seasoned investor in his 70s. He's done everything in real estate, and he asked me once, we're talking about a deal, and it's got a 5-year debt maturity, and his question was, "What do you do if you can't refinance and there's no one's lending?" And I couldn't make up a good answer to that. It's like, man, I guess if that's the case, then dare I say we've got bigger problems than refinancing this deal with a debt maturity issue. But yeah, if the capital markets and debt markets seized up, that's a big problem for everybody in the world, frankly.
It's a big problem. It's what we saw in 2008. It doesn't seem like we're headed towards something like that, but that's been my biggest fear since dealing with that issue in 2008 has always been, can you get access to debt? Fortunately, in 2008, you still have Fannie Freddie who are doing loans, but it was just really hard to get in there. And so we built into all of our business plans that we always go agency um,
Yeah.
for that specific reason. So talk to me. So I have exposure to multifamily. Primarily, we're in mobile home park space, affordable housing, modulars, et cetera. But tell me, how does, you know, your portfolio, you've done a lot of different things, but how does it stack against multifamily? So how is storage doing as compared to multifamily?
Well, we've got over 19,000 units. We've got 38 facilities, just over 3 million square feet. And storage is an asset class. I love multifamily too. I think the need for workforce housing is going to just keep growing in the coming years. The affordability gap continues to widen. If you could almost buy a house a couple years ago, you're making the same amount of money now. You're definitely not buying a house now, given what interest rates have done. So I think it's a defensible space. I would say the biggest difference between multifamily and storage, I guess there's a lot of differences, but no, the one is, I'm going to sound like a heartless capitalist here, but we don't have fair housing laws. So remediating a delinquent tenant and correcting that is a lot easier in the storage space than multifamily, especially in some of our less landlord friendly states. We all know who those are. No offense to you New Yorkers listening. But we can remediate delinquency pretty quickly. It's a lot easier to do. And another big difference, and this isn't just comparing storage to multifamily, but storage to really all asset classes, is our leases are month to month. And that's a good thing. It's also a bad thing to a degree. The good part of it is we can respond real time to supply and demand changes at the unit level, the facility level. So if we have 10 by 10s, for example, that are really full, and we're still below market, we can raise rates on those incrementally and probably not get a lot of move outs. And likewise, we have a 5 by 5 unit type that's maybe lighter on occupancy. We can drop our rents below market and fill those up and then start increasing rents over time. And obviously, multifamily, you're churning leases every year or two, and you lock somebody in on day one, and rents go up 10% in the 6th month. They're still paying the same freight they were before. The other kind of difference is generally the operating expenses are quite a bit lower in self-storage. However, you often hear kind of the one-liner that self-storage compared to multifamily, no tenants, no toilets, no problems.
Yeah.
And that could not be further from the truth. Self-storage is very operationally intensive. We have hundreds of people moving in and moving out every month. We have theft problems. We have U-Haul trucks backing into our $30,000 gate system that we just installed. We've got drug issues. We're getting served like DEA search warrants because somebody's storing drug cash in their storage unit. That probably happens once a month. We have people sleeping in units when they're obviously not supposed to be, right? They'll come in and close the door and set up their sleeping bag and just hang out. So it's very operationally intensive. So don't ever think that it's just a passive, easy, just fire and forget. That kind of could not be further from the truth. We have almost 90 employees, and customer service is always top of mind. And we're to a degree, we're almost a retail-facing business more so than we are a real estate investment company. So it's very operationally intensive. But with that being said, it's historically downside protected. If there's a big recession that's on the horizon, which was supposed to start like 2 years ago, I think, and I'm looking out my window, I still don't see it.
Yeah.
But historically, it's been pretty defensible when there's a downturn and also in good times. And really what drives consumer demand in storage is people moving up and down the economic ladder, getting a job, getting fired from a job, getting married, divorced, upsizing or downsizing their homes. That mobility is kind of the demand driver, and good times and bad, people tend to be fairly mobile. The challenge in the industry the last year and a half or so has been, first of all, the housing market's kind of frozen up to a degree, right? Not a lot of people are moving. They don't need storage as much. We also learned at the recent national self-storage conference in Vegas a few weeks ago that multifamily renters, this is a broad stroke statement, but multifamily renters are renewing their leases now in the units they live in at a higher rate than they ever have historically. I'm not sure why that is exactly, but those people are not moving after the first year. They're renewing into year 2. What does that do for consumer demand for storage? Well, it drives it down, right? Because they're not moving as often.
Yeah.
But I think as transaction volume kind of spurs and we see a declining rate environment, we'll start to see that mobility hopefully kind of increase in the coming quarters.
That's fantastic. I just, as you talk about that, I think about your earlier statement about, um, every model is wrong. I used to have a boss. I came from healthcare, and one of the big hospitals I worked at, my boss, um, the CEO, used to say every model is wrong, but some are useful. We just need to remember that the models are always wrong. And so you can't forecast that all of a sudden leases are going to get renewed at a higher rate than ever before. We always knew rates were going to go up, but nobody anticipated a 500% essential, like a 500% increase in 1 year of interest rates. It just kind of imploded the commercial real estate market. All of our
Yeah.
models, we had, declining rent amount, not going up, 5%, 4, 3, 2, like that on the average rent. At least that's how we were doing it at the time. We do something different now, flat or even declining rents, which we're seeing in Dallas, Fort Worth, and some other markets, even strong markets. We're just seeing declining rents.
Yeah. Yeah.
Yeah,
I mean, you hit an affordability ceiling, right? People just
yeah,
eventually couldn't keep paying, you know?
they can't
It's
keep paying, and you
yeah.
got 4 million retirees retiring every year now. And they're all going into average of like 47,000 a year. And our median income is $47,000 a year for a retiree. It's an interesting time in the marketplace, and it's going to be interesting to see how things pony up over that, not pony up, but like trend over the next 5 years with all the changes that are happening. If you had a crystal ball, how do you think storage is going to fare over the next 5 years?
Well, the main risk in storage, outside of your normal real estate risks like rents, cap rates, interest rates, the overall health of the submarket, your main risk in storage is the introduction of new supply. It's a very local supply sensitive business. So we track supply ratios in the 1, 3, and 5 mile trade radius. And the good news is, depending on the market, I mean, other markets are totally different, but generally we've seen a major decline in new development for the obvious reasons, right? It's tough to raise money. Development loans are tough to get, lower leverage, inflated hard costs. So I think we see a good story for, again, broad statement, but generally muted new deliveries and
Yeah,
muted new supply, which tells a good story for kind of retaining occupancies and consumer demand on our existing facilities. It's a fairly uniquely American asset class. People buy a 5,000 foot house and they fill it up, and somehow they need storage still, right? It's a
yeah,
it's a sticky customer base. But yeah, it's been historically resilient. It's had some challenges like everything the last couple of years, but we like the go forward story. But the old crystal ball is always wrong.
yeah. It's always wrong, but I always love those. He predicted all the whatever. You're like, uh-huh. I'm sure he did.
Yeah,
Yeah,
the broke clocks are right twice a day, right?
yeah, they're right twice a day. Yeah.
Yep.
The market will crash. I predict sometime in the future the market will crash over the next.
I think that's a safe assumption to make. I'm totally on board with that.
Yeah, whether it happens tomorrow or 50 years from now, I have no idea.
Yes, yes.
So I've heard some criticism of storage being that, you can only make money there if you're institutional. And so what do you say to that? Is it just a big guys game like Van West Partners? You guys have 2 million square feet, or can little guys still make money in storage?
Well, sir, it's 3 million square feet.
Oh,
However,
excuse
we
me,
are
sir.
we are still a little guy. We are
Yeah,
we're kind of we're up in the ranks, but there's 30 or 40 or more operators that have a lot more than we do. Yeah, to answer that question, I don't have enough time to answer it like I want to, but we used to think that the REITs did it best. They know what they're doing. They've got this secret sauce. And when we first got in the business, we used the REITs to manage our facilities because we didn't know what we didn't know, right? We never
mhm,
managed storage before. We're bootstrappy, we'll go figure it out. But we use the REITs. And big surprise, but we found over time that our interests were kind of misaligned. So they were keeping a lot of the ancillary income streams like tenant insurance, which is pretty meaningful. our facilities were heavily loaded with marketing allocations that we couldn't necessarily defend, that are driving customer traffic to our location. Heavy operating expenses, solving mainly to occupancy growth and not revenue growth. And the two are kind of, they can be very different. You can have a decline in occupancy, but an increase in revenue in the storage business. And, as we kind of learned the business over time, we started self-managing our own deals and taking the deals back from the REITs kind of incrementally. And for many years, we've self-managed our entire portfolio. And we're definitely not smarter than the REITs, and we're obviously not bigger than the REITs. But we've created a lot of value just because we pay attention. That's all we do. We just pay attention. We're not real smart, but we look at every operating expense. We very dynamically manage our revenue. We're touring our facilities constantly. We have a great team that runs our asset management. Our property managers are on sites. And we create value just by paying attention. And we can compete with the REITs, and we do compete with the REITs. We have a lot of markets we operate in where there's numerous EXRs, extra spaces, cube smarts, public storage, and we still perform well just because we pay attention. So it's not just an institutional game by any means. However, if it's a widely marketed deal going through like a national brokerage outfit, and there's a call for offers and a formal sales process, we can almost never compete with these big institutional players because their return targets are so low.
Yeah.
We'll still put our hat in the ring, but we get blown out of the water by anything that's marketed most of the time, and by most of the time, like 95% of the time. Yeah.
Yeah. They're happy producing a 5% return to their investors,
Yeah.
And how do you compete with that?
Yeah. Well, the only way you do is you pay more, or you lie to yourself and your assumptions on NOI growth.
Right. How wrong do you want your model to really be?
Yeah, less. We try to make it as less wrong as possible, least wrong as possible, and we try to make it wrong in the right direction as much as we can.
Yeah. Perfect. I love that you said that. When I was early on in this game, I thought the same thing. I thought, man, these REITs have just got it nailed down. And then we started buying apartment complexes that were coming out of a REIT, and they were distressed, ran down, and
Yeah.
everything else. And you're like, huh, this was owned by a REIT, like huge institutional firm. They've had it for 20 years, and they've invested $0 in it over the past 20 years and run it down. And the expense ratios were just insane.
Yep.
Uh,
Yep.
and
Yep.
and
Yeah, there's value to create buying from these bigger operators, believe it or not. And we didn't think that was the case years ago, and we've certainly learned it is the last few years.
well, it's a model. Just go find their old stuff that they don't put in their marketing brochures and they don't tell their investors about. That's the
Right.
stuff you want, right?
Agreed.
Interesting. So looking back in time, Jacob, what would you tell yourself, Jacob, early on, coming out of the fire department, wanting to get into real estate and, doing single family homes or whatever? What would you tell that guy, still wet behind the ears? I don't know if people say that anymore, but, what would you
Well,
tell him now?
many years ago, I would have said, make a spreadsheet and figure out if your rent's higher than your mortgage payment. I probably would have done that. That's always a good place to start. Making
Always a good place to start.
making sure the property produces enough income to pay your debt. That's a good safety tip for those of us who may not know that listening right now. And I've already touched on this, but I also would have said, do whatever you can, as much as you can, to hold on. And that was for all the reasons we mentioned. It was really tough to do back then. But hold on, and don't let a really high IRR incentivize you to sell quickly for a low amount of profit. We've done that a few times too over the years. Like, oh, we're only making this much, but we'll do it real quick and we'll do a crazy IRR. IRR is one of the most misunderstood and elusive return metrics out there. I don't even understand it, and I'm a real estate finance guy. It just makes deals look better or worse than they actually are. What we care a lot about more is multiple, meaning how much money do you expect to make on a given deal as a percentage of what you originally invested? And then are you going to realize that over a rational amount of time, right? Like if I tell you, hey, Sam, I can double your money on this investment, you might say, oh, that sounds good. Okay. If I tell you I can double your money on this investment over 20 years, that's not so good,
That's
right?
terrible.
That's where IRR comes in, right? But I mean,
Yeah.
if I tell you I can double your money in 5 years, okay, that's good. If I tell you I can double your money in 6 years, that's also good. It's also a
Yep.
reasonable amount of time to do a 2x, but your IRR in the 6 year scenario is going to be materially lower because of that additional elapsed time. So as you look at different deals out there, understanding those two metrics and blending them together, I think is important, and not looking at deals through one lens to the other, but in conjunction with each other. And for a long time, we just looked at IRR, and that's one of the things I would go back in time to try to straighten myself out on. Don't let that drive you, for sure, and just hold on to assets. And always remember, it took a long time to learn this too, but debt does not make a bad deal good. It makes a good deal better. And we can all get kind of caught up in, oh, I can pay too much for this because I can get really cheap debt on it and it's going to work out. And that's not a good thesis to operate under by any means.
It's not. Your basis still matters in the end.
Yeah, the old basis problem, right? No problem deals, just basis problems.
Yeah, that's it. Because the reason that we were able to save, multifamily deals that got upended by the interest rates was because we had a low basis.
Yep.
And
Yep.
it such sage advice, Jacob. I really appreciate that. And I hope our listeners heard what you said and can think about that from, when you're investing with operators, you want to invest with people who have been in the game for a long time and they understand that they make a ton of mistakes. You've talked about this quite a bit. Well, yeah, we could spend another hour talking about all the deals that have gone sideways for one reason or another. We paid too much. We thought we were doing a great job, but we paid too much. We got into it, paid too much. Or the market went sour. The market always gets a say. Political issues. There's like so many things that can go wrong. But like you said, if you have a basis, the right basis, you can save or you can overcome a lot of material issues that you have no control over at all.
Yeah, not that I'm in any position to give advice, but since I'm been granted a microphone and an audience with you, I guess I will anyway. For those of us listening who have been kind of thinking about getting into real estate investing and listened to podcasts, read the books, gone to the classes, the only way you're going to learn is by taking action and taking a risk. Everything's got risk to it. Even the treasuries, to a degree, have a small element of risk, right? The U.S. government could default someday, and who knows? I mean, it's more likely than it's ever been. But everything's got risk, and this game, creating wealth in real estate, it takes a long time. It doesn't happen fast. And if you're sitting on the sidelines, kind of thinking and waiting for the perfect deal, you're missing out on the benefit of that time. And I think taking action and taking risk, there's never a perfect deal. And I don't think we've ever bought a deal where we didn't feel like we kind of paid a little too much for it. I can't think of hardly anything that we bought where we're like, oh, we're robbing this thing, other than like going back to '08, and maybe even at the time we didn't realize it. But it just doesn't, it never feels like there's a perfect deal out there. But if you're not taking action and taking risk, you're not creating wealth.
Yeah. Thank you. Fantastic. What Grant Cardone says, pay too much. He always say, I always pay the most out of everybody else for this deal.
Yeah, yeah.
Hold on
I
to
don't
it
think,
for,
I mean, I would say that we pay the most too. And we have some deals where the only buyer that saw it. So I guess you still pay the most or the least if you only want to look at it. But yeah, you're not looking at a $20 million deal. It's got $20 million offers on the table and buying it for 15. You're buying
yeah.
it for 21, right?
Yeah.
Or 22.
Because you're not playing the game if not, and you can't
Yeah.
even do it at all, but you can overcome a lot of market things by holding on for a long time. At the
Yep.
beginning, you said, people who have lost, and I do too, people have lost 100% of their capital in multifamily. It's just kind of been a bloodbath the past year or two. I don't
Yeah.
really see that as much in the other office before then. Multifamily now, people are just losing 100%, 90% of their investment. What would you tell those folks who have lost their money in those deals?
Well, I mean, it depends on their financial situation, but there's a lot of entrepreneurs out there that have failed over and over again. And I failed in, 06 to 08, right? And had I stopped, I'd probably be doing fine, doing something else. But I love doing this. I'm not smart enough for anything else. Real estate's simple enough where, I can understand it. But don't let that dissuade you from just staying out of the game completely. Don't let that make you return to just typical retail stock investing, right? I think anybody who's trying to create wealth should have real estate investing as a component of their wealth creation strategy. And just because a deal goes bad, doesn't mean the next deals you might invest in are going to go bad at the same time.
Yeah, well said. Well said. Well, Jacob, thank you so much for being on the show today. Our listeners hopefully have been as inspired as I have been listening to you talk, share some of your wisdom, your experience with us. I really, really appreciate that. How can
Sam,
they,
had a blast.
how can, how can they get a hold of you?
Always love to talk about real estate. Always looking for deals. If you got a storage deal you've heard about, we'd love to hear about that. People can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Excellent. We'll make sure that those are in the deal notes. So folks, you can get access to Jacob, reach out to him, please do that. And if nothing else, you say, look, I just lost 100 grand in my deal. What should I do, Jacob? And I'm sure you can give them some more sage advice for their personal situation.
I'll see what I can do.
Wonderful. All right, folks. Thank you all for joining the call today. Jacob, again, thank you. Really enjoyed speaking with you, and very impressed by your outlook and your reality, your realism that, we're all entrepreneurs here. We're trying our best, some more so than others, but the big thing is just to keep on going. And
Thanks again, Sam. And here's to declining rates in 25.
Yeah, hoorah. All right. Thank you. Thank you for tuning in to Clean Money, where we talk about sustainable investing that improves society. We are passionate about creating great investment returns to investors who want to use their money to make a positive social impact in the world. If you enjoyed the episode, we'd appreciate a 5-star review. And if you are interested in making your investing matter, please connect with us at wildmountaincapital.com, or you can find me, Samuel Sells, on LinkedIn, on Twitter at Sells_Samuel, on Instagram at Clean Money Sam, or on Facebook. And finally, make your investing matter.